events, and some of them involved the TMF actually, but this time is slightly different. We are particularly delighted to welcome Tamim Bayomi to Bruegel today, who is now doing a little tour promoting a new book he wrote. He took a year from the MF out, went to the Peterson Institute, and this is the result of his year at the Peterson Institute, and he very kindly agreed to come also to Brussels and present some of his thoughts on the crisis. And I'm also particularly happy to welcome the discussant today, Art Hubern, who is the head of financial markets at the Dutch Central Bank. And previously he was the head of financial stability at the Nederlandse Bank during the crisis. So he will have interesting insights about the book, but also about general events, the way that he has experienced them in the bank. Thank you both for joining us today. We'll take about 30 minutes for the presentation and then 15 minutes of a discussion. And then, as usual, we will always open up the discussion for our public. Let me say, I have started reading the book, and I've read the introduction, and then I went immediately to the European chapter. It doesn't sound like a very pretty story, but I stopped and I decided that I'm going to wait for Tam to give me the executive summary, and then I will go back and read it. I will say a few things about that reflect how I've always looked at Tam's work. Back in the 90s, Tam wrote and I say that as a student of European Union, he wrote a very important article on the way that we modeled monetary union, which had the fantastic title of Shocking Aspects of Monetary Union. I was very impressed with the title back then, and Tam has confessed that he spends a lot of time thinking about titles because they are important to grip the audience. And this time is no different. I said there's unfinished business, and I would like to ask Tam to tell us how would we finish the business. Tam, the floor is yours. Thank you.
Well, thank you very, very much, Maria. And I'm absolutely delighted that Bruegel gave me this opportunity and that they invited me. And quite apart from being able to reacquaint myself with lots of old friends, there are a couple of reasons for this. One of which is I should acknowledge that André Sapir provided me with quite a lot of very, very useful data, some of which I will use in this presentation. But the second is, this provides me with a fantastic opportunity to try out my narrative about the crisis on a non-Anglo-Saxon group. So it'll be very interesting to see how that goes down, and I'm really and genuinely looking forward to the reaction. So, I'm going to start with by far the most boring part of my talk, which is to say, this does not represent the views of the IMF, it represents my own views, nor the views of the Peterson Institute for International Economics. But here's the book, Unfinished Business, and by the way, there are out flyers which give you a 20% discount. So feel free to take advantage of them. So 9 years ago, the Lehman Corporation failed, and the North Atlantic economy changed. Before then was a view of continuing prosperity, safe nest eggs, backed by savvy policymakers who understood the economy. What came afterwards was a new mediocre comprising low growth, uncertainty about the future, lackluster investment, and a loss of belief in the expertise of experts. So, and of course, along with that, a lot of political and social change. So the reason I wrote this book was in part out of frustration with the many books that have been written, in terms of the fact that while there have been lots of books on the crisis, they started from what I regard as the middle of the crisis. They started, for example, it was a description of what happened over the crisis, not how the crisis came to be. Okay, so big banks arrive, fully formed. Securitized markets are simply there as a problem to be solved. What I wanted to do was go back and try and explain how these things happened. There's another aspect of those books which I also didn't agree with and wanted to set the record straight on, which is they almost always look at either the US half of what I call the North Atlantic crisis or the Euro area half. In my view, the two were parasitically intertwined, and I'll explain why in a bit. Okay? So I think still that there was one North Atlantic crisis, not a separate US and Euro area crisis. So, so in this book, I ask the seemingly simple question, which is, how come the North Atlantic economy became so parasitically intertwined that the failure of a medium-sized US investment bank could plunge the entire region into a deep recession and the euro area into a depression? The answer lies in a whole series of regulatory missteps that occurred going all the way back to the 1980s on both sides of the Atlantic. These culminated in a decision in 2003, an obscure decision by the U.S. Securities and Exchange Commission, which propelled the final melding of the two halves of the crisis and brought about the crisis itself. So I'll here use two analogies from a different literature, that of the First World War. What I was aiming to do was not write about the First World War. I was aiming to write about the origins of the First World War. And in a sense, from about 2003 on, although much happened, in my view, most of the actors were actually sleepwalkers. Most of the changes had already occurred by 2003, which were to precipitate the crisis. So let's start with the less well-known, and probably of more interest to this particular audience, European side of the story. So, the story goes back to the 1980s, and in the mid-1980s, the Single European Act had various effects, but its most important effect on the banking industry was to enforce a wide-ranging universal banking model. So universal banking means that a bank is allowed to both do commercial loans, loans to people, loans to firms, and investment banking, buying and selling of assets. Okay, so particularly in Northern Europe, there became a whole series of large banks which had this universal banking model. These banks then very rapidly prospered over, when in the mid-90s, the Basel Committee, which oversaw international rules on banking, passed an amendment which allowed banks to use their own internal risk models to calculate the capital behind their investment banking operations. Now you see why universal banking mattered. Unsurprisingly, given this opportunity, these banks manipulated their internal risk models so as to save on expensive capital, and they used the capital that they saved to expand further. So they both became ever larger and ever more unstable. So to illustrate a couple of these things, here is a picture of the Euro area banking system as a ratio of its own GDP. Okay? So the blue bit is everybody else, and the 12 bit is what I call the 12 mega, in the book, the 12 mega banks, which are the 12 largest banks in 2008. Okay? Now, what you can see is already by 2002, the European banking system was large. It was well over 200% of GDP. That's over twice the size of the US banking system, and also oversized as a ratio to GDP of the Canadian banking system and the Australian. So it was a large banking system already. And the mega banks mattered. They were about a third of the system. But if you look since after 2002, with internal risk models behind them, the 12 mega banks expand much more rapidly than the rest of the system. Indeed, the rest of the system hardly moves. So that by 2008, the assets of the mega banks had doubled as a ratio of the region's GDP, while it had hardly moved elsewhere. And that these mega banks made up almost half of the rapidly expanding euro area banking system. So how did they do this? Well, here is a picture which shows you the capital requirements of these banks, okay? And I told you they manipulate an internal risk model. So on the horizontal axis is capital as a ratio of total assets, okay? On the vertical axis is capital as a ratio of risk-weighted assets. And what you can see is 1996 is what you'd expect. These are two different ways of measuring how sound a bank is, okay? Positive relationship and just what you'd expect. This is how it looks by 2008. The relationship is not only not positive, it's actually negative, okay? In this topsy-turvy world, a universal bank where €1 of capital supported 60 euros of loans was regarded by the regulators as better capitalized than another bank where €1 of capital supported 12 euros of loans. And unsurprisingly, it was the larger bank that got into trouble over the crisis. Now, how did this come to be? Well, that comes to the third part of the story, which is the 1992 Maastricht Treaty, which decided to leave bank regulation at the national level. Now, this had two effects. The first was it made the banks extremely large and very difficult to save. So, to give you an example, ING of the Netherlands had assets of over 200% of Dutch GDP. Okay? And by the way, they weren't alone. BNP Paribas had assets of 100% of French GDP, and Deutsche had assets of almost 90% of German GDP. Okay? Now, take that over 200% of ING. That's larger than the entire US banking system's ratio of its GDP. These banks have already become far too large, not only to fail, but also to save. And this explains why over the euro area crisis, all sorts of things were done to make it out that the banks were okay, because they couldn't be saved. The other effect that the Maastricht Treaty had was to bake regulatory competition into the European cake. Okay? So what happened was, over time, the national regulators saw themselves as supporting their own banks against the other people's big banks. So rather than becoming worried about safety and soundness, they became worried about boosting their own national champions, as they were called. This helps explain why this increasing instability of the banks was missed. And of course, its most obvious example is the movement to light touch regulation in both the UK and Ireland. But it was a much more general phenomenon. Okay, so that's the euro area half. Let's now move on to the American half. The American banking system also destabilized from the 1980s through to the crisis, but in a very, very different way. And this was because the American banking system had a complete different structure. You remember I was talking about universal banks which combined commercial and investment banking. In the US, these two were separated. Okay, you were either a commercial bank or you were an investment bank. But even more importantly, commercial banks were under bank regulation, but investment banks, despite being called banks, were actually not under bank regulation. They were under much looser and separate regulations. Okay. Now, this didn't matter for a long time because the investment banks were very small. But with the inflation in the 70s and the 80s, the commercial banks became much less competitive for depositors because they had caps on their deposit rates. So what happened was deposits moved from the commercial banks across to the investment banks, which were under no such caps and therefore could offer much more competitive rates. Okay? So where deposits moved, loans followed. So increasingly what the commercial banks did then was they took fairly standard and simple loans such as mortgages, and they put them all together and they put them into these securitized assets, and then sold these mortgages to the investment banks, which were the center of the shadow banking system. I told you they were under very light regulation. They were also the center, they were the people who financed the hedge funds and all the other parts of the banking system, of the shadow banking system, okay? The investment banks were the center of the shadow banking system. So, why did these securitized assets work? There was almost no economic logic behind them. They were simply transferring a mortgage from a commercial bank to an investment bank. They worked because the commercial banks, if they kept these mortgages on their books, they had to hold a lot of expensive capital against them. The investment banks had to hold almost no expensive capital against them. Therefore, it was a pure case of regulatory arbitrage. Okay? That's what drove the securitization market. Now, to give you an example of the transformation in the US housing market, here you have a picture which shows you the mortgage market in the US in both 1980 and 2002. The blue is the amount of mortgages that commercial banks kept on their books. The grey is sort of government-guaranteed things, mortgages, and the red is mortgages sold through securitizations. Well, you can see it's 1980. Securitizations hardly matter. By 2002, they're the dominant way that mortgages are produced and sold in the US. Now, an obscure change in regulations in 2003 not only worsened the problems in the US, but also brought the increasingly fragile European and US banking systems together. So what happened was in 2002, the US SEC widened the rules on collateral of repurchase agreements. This is pretty obscure, but so what's a repurchase agreement? It's a way that sophisticated investments borrow dollars. So the way a repurchase agreement works is I have an asset, I lend it out to you in return for dollars, with an agreement that you will repurchase it at some future date for a fixed price. And basically the difference between what I sell it and what I buy it is the interest rate. Okay, so that's how a repurchase agreement works. Now, before 2003 in the US, essentially the only collateral that investment banks could use with their clients for a repurchase agreement was treasuries or similarly incredibly safe assets. Okay, 2003, the SEC widened it to two other types, well, a bunch of other types, but two which really matter. One type of asset was mortgage-backed securities. Okay, now this caused a big change in the way that the securitization market in the US moved. Because before 2003, okay, basically mortgage-backed securities were about putting people in houses. And as a result, the vast majority of the securitizations which were done through the two government-sponsored enterprises, Freddie Mac and Fannie Mae. Okay? Now, they guaranteed the underlying mortgages. Okay, so effectively the securitization market was reasonably safe because even though theoretically there wasn't a federal guarantee, everybody thought there was a federal guarantee, and it turned out over the crisis when Fannie and Freddie got into trouble, there was a federal guarantee. Okay? But after 2003, all of a sudden, this MBS paper became a liquid asset that you could use to get dollars. Okay? And as a result, there was a huge pressure to produce high interest rate mortgage-backed securities that would be easy to trade. So from 2003 on, you see the red bit. By the way, the red bit's always the thing to look at in these pictures. The red bit gets bigger after 2003. This is private label securitizations. So this is where what banks did was they took mortgages that the GSEs would, which the GSEs wouldn't touch, and in particular the famous subprime mortgages that failed over the crisis, which the GSEs were for borrowers who were too poor, who had too low credit scores for the GSEs to accept. Okay. They took those, and rather than giving a guarantee, they just sold them straight to the shadow banking system. And as you can see, by the crisis, a third of the US securitization market was made up of these private label securities. And these were the guys who failed over the crisis. Okay. Now, I promised you that there was another half to this that brought the European banks into the picture. And so the other thing that the SEC did was it widened repo collateral to high-class international paper, foreign paper. Okay? So this caused, and the large Northern European banks were already expanding fast. They started expanding very fast internationally. So up till about 2000, although the Northern European banks were expanding fast, a lot of it was internal. But they started running out of markets internally. So here you can see in 2000 and 2007, the value of foreign assets of the Northern European mega banks, actually the banking system in general. What you can see is that by 2007, Northern European banks owned 50% of their own GDP in terms of assets in the US, and 30% of their own GDP in assets in the periphery, which they also saw as a valuable thing. Why did they expand so much into the US? That's where investment banking was. And remember, with their own internal risk models, they didn't have to put much capital against investment banking. Why did they go to the South? They went to the South because they thought there was money to be had there. Okay? Now, in terms of the recipient GDPs, it's approximately reverse. So these assets were worth about 50% of periphery GDP and about 30% of US GDP. Okay? Now, these inflows help explain a couple of things. And the most important is why the financial conditions were so easy, which helped precipitate the bubbles in the periphery, Euro area periphery, and in the US. For example, in the Euro area periphery, these massive inflows from Northern Europe help explain why these governments were able to essentially borrow at the same rates as Germany. Okay? In the US, there was also much easier financing conditions, although the story was a little more complicated there and involved the Chinese as well. But these inflows were not unimportant. So, if we come back, what happened was the North Atlantic financial system destabilized, but destabilized in different ways on either side of the Atlantic. In the Euro area, it destabilized from the major banks. So it destabilized from the center, okay? In the US, it destabilized from the edge as less important shadow banks started taking over a lot of the roles of banking, okay? And this is important because it explains why things were so much worse in the Euro area, because it was the center of the system that was the problem in the Euro area, whereas the periphery of the system. And of course, the 2003 SEC decision created what I call the cross-Atlantic financial drift, as people use repos to get dollars and use them to buy mortgage assets. So, that's how it happened. Why didn't anybody see it? Well, the answer to that involves a whole series of intellectual blinkers that meant that people both missed the growing risks and, in some cases, amplified the cost. So the most obvious case of amplifying the costs is the faulty architecture of the Euro area. Okay? So the Euro area was there were always two views in the discussions about the single currency, about its purpose. The French always regarded the single currency as a way to get to a fully integrated European economy, okay? And therefore, in the interim, while you're moving from a less integrated economy to an integrated economy, you should have support for countries. Okay. The Germans had a completely different view. Their view was you should only create a single currency after you'd created an integrated economy, and therefore you didn't need support for governments. And indeed, it could be harmful, because it could create bad incentives. What you ended up with in the hurried negotiations to create the euro after German unification was the worst of both worlds. You end up with an early French currency, but with a German no bailout clause. And that explains why you ended up in a situation where bank problems put pressures on national governments, and national governments' problems then put pressure on banks. Remember, ING was over 200% of Dutch GDP. It was only 15% of euro area GDP, which is about the same as Citibank, which the Americans could bail out through the TARP program. Okay, that wasn't available because the bank was so much bigger. So, there were some other intellectual blinkers that actually made people miss the growing risks. Okay, so the first of these was the efficient markets hypothesis, which essentially argued that financial markets could discipline themselves. And it was actually an overinflated belief in the efficient markets hypothesis, which led to the disastrous decision by the Basel Committee to allow internal risk models to be used to calculate banks' capital. The important thing to understand about internal risk models is, to a very large extent, they weren't there to actually regulate banks. They were there to actually allow banks to regulate themselves. Okay. So, a second intellectual blinker came from the observation of the Great Moderation. So there was this observation that around the mid-80s, the amount of fluctuation of GDP went down. And although various explanations were given, the explanation which became popular was that this was due to much more effective monetary policy. Okay? And this led the central banks to believe that not only did they not think there was a bubble, but even if there was a bubble, it was better to let the bubble grow and burst because they could pick up the pieces afterwards. A sort of misassessment of the situation for which we're all still paying. Okay. A final intellectual blinker was what was called benign neglect. So this was the belief that the best thing you could do was look after your own economy, and that everybody else's economy had such small spillovers on yours that you didn't need to worry about them. All you need to worry about was your own policies. Again, an intellectual blinker which turned out to be spectacularly wrong over the crisis. So, where are we now? Well, policy-wise, it's a mixed bag. In the US, importantly, from the point of view of the story I just told you, not only have capital rules been raised, but also the investment banks have been brought in to the same rules as the commercial banks. Okay? So to all effective purposes, the US shadow banking system was ended through that change. Okay? And indeed, you will see that there was almost no securitization going on. Okay, so with the bringing of the investment banks into normal banking regulation, the logic of securitization disappeared. The euro area is a much more complicated story. Obviously, there is higher capital requirements, but to this day, and I'm aware of the fact that in 2018 there's a planned change, but to this day, the major European banks are still only under internal risk models for their formal capital requirements. Turning to bank supervision, the ECB is now in charge of all large banks, so that's good. We no longer have the regulatory competition. But the support for banks is still at the national level. So the Dutch government is still responsible for ING, which clearly is a complication in the system and creates a lot of interesting incentives. Finally, when we get to the architecture of EMU, Well, we certainly, we have created mechanisms to support countries in crisis, but only if they're prepared to admit that they're in crisis and submit to an EMS program. So this is certainly not going to be used preemptively. Turning to the intellectual blinkers. Macroeconomics has spent quite a long time looking at macro-financial linkages. But to this day, most of the mainstream models that are used still have all of the limitations of the models previously. So they still have self-disciplining financial markets, they still have extremely effective monetary policy, and they still have limited spillovers. Okay? So progress is being made on one end, but it's not being shown in the mainstream. Those who do not learn history are doomed to repeat it. What I've tried to do is tell you a story where what happened was the result of a series of errors, albeit made for understandable reasons. And this is important. None of the errors which I've told you were not made for reasons which made sense at the time. Okay? And that's actually quite a hopeful statement. Because if people made errors, you can unmake them. Okay. A lot of the popular descriptions of this crisis have to do with essentially, sort of crooked behavior by people, be it U.S. investment bankers, be it Kahas, be it whatever. What I'm trying to tell you is that, I'm sure those people are around, but they're always around. Okay, the question was, why were they given the power to be able to be so important? Okay, so what I've tried to do is tell you a story about how the crisis came along, which does not require as a central plank people being dishonest. That's why I think that people are sleepwalkers. Okay? Now, so the reason I wrote this book is so that we can understand the history, understand the deep forces that drove the financial crisis, and therefore do really get to the roots and change those and finish the unfinished business. Thank you.
Thank you. Thank you, Tam. That was indeed a very interesting story. I'm sure all of us want to engage with you, but not before we give the floor to Art for his first thoughts. Art.
Well, thank you very much, Maria. Thank you, Tamim, for writing this book. It's an extremely rich book. It's broad, it's encompassing, it's political, it's historical, it's knowledgeable, it's readable. It's a book you really want to read. It's a book, an analysis of the root causes of the crisis. It's not a book that gets you in a straight route from the crisis to the causes to the remedy, but it meanders its way through different topics in history, in politics, and in financial economics to explain why the crisis occurred. I particularly found it a very compelling book when I read it, because I've been trying to understand why, coming from a country where we save more than is good for us, we are extremely thrifty, I'm from the Netherlands, where we are extremely prudent, we have very high levels of prudence in our society. Nonetheless, it came to be that 3/4 of our banking system ended up on life support. And then you ask the question, why? And this is the sort of book that tries to explain why. And it's a fascinating read, and there's very much in this book to agree with. So, I thought I could mention all the things I agree with, but that's not what Maria asked me to come here for. So you asked me to look at the book critically, and I basically want to give 6 points. I want to mention the question why, go into the question why it happened. Secondly, to say something about the way we finance our economies, and there's an important lesson there. Thirdly, the importance of having an additional policy instrument next to monetary policy and supervisory policy to ensure the stability of the financial system. Fourthly, I found Tam overshot in his critique of internal risk modeling, and so I want to give a bit of pushback there. And fifthly, his criticism for the lack of public support for banks, I think, overdoes it, but I'll explain why. And then I'd like to end with a few thoughts on the achievements that have been established over the past decade. And I think the glass is at least half full on account of those achievements. So let me start with the question why. The fundamental question, why did this happen? I think it's a very important question to pose. And Tamim also in the book says a couple of times, why did policymakers not pick up the problem? I think the first thing we need to establish, it wasn't just policymakers, it was everyone. So it was investors, it was financial markets, it was households, it was governments. No one saw it coming. Even academics in the gross majority didn't see it coming. I recall a report by the IMF in 2006 talking about the financial system being better able to price risk and to shift risk to those places that were best able to bear those risks. So, this was endemic for the way we all looked at the financial system 12 years ago. So I think it's very important to say this, because what does that mean? Why? So the question is why we underestimated risks. That's the big issue. We underpriced risk. That's the consequence. And thereupon, we also had too few buffers in the system and too little resilience. And that was not only in the banks. Also, the governments had too few buffers. But in my country, households had too few buffers. So it was endemic to the whole economy. And it's also the difference between looking back, like this book does, when you have 20/20 vision, when you look in hindsight, and when you look in the future and you deal with uncertainty about how the future is going to unfold. And there's a fundamental point, Knightian uncertainty, fundamental uncertainty, that you don't know what the future is going to bring, which means that you also always need to build in a certain degree of resilience, a certain degree of certainty and security into your system and into your balance sheets. And I think we did too little of that in the run-up to the crisis. My second point is on how you finance. So Tam goes into the fact that Europe had a lot of large mega banks. Now, the issue I would say is it's not only the size of the banks, but it's particularly how you finance from savers to investors and consumers. How do you transmit finance in an economy? And even if you have a lot of finance, you can do this through banks, or you can do it through markets. Markets, for instance, an enterprise that wants to fund itself can go to a bank, but it can also go to the market and issue a bond. Now, the experience until 2008, research looked deeply into the issue. Is one financial system better than the other? And it was inconclusive. It was neutral. We can't say whether one is better than the other. If you do the same research now, you will see that bank-oriented financing systems are much more vulnerable, much more liable to systemic risk than market-oriented financing systems. So a bank-oriented financing system, like in Europe, means that the European economy has an additional vulnerability in comparison with the United States. And that's something you can do something about this. So you can try and change the system to make your economy more resilient. Third, the lack of policy instruments. Prior to the crisis, we thought that monetary policy directed at stable prices and supervisory policy directed at stable institutions was enough to ensure a stable system. After the crisis, we had a new objective, which is financial stability, which was the stability of the system as a whole, but we didn't yet have instruments. And we've been developing these instruments over the past 10 years. These are macroprudential instruments, and we have them now. So we have countercyclical buffer requirements for banks. We have LTV ratios being required for households. We have systemic risk buffers being required for banks, et cetera, et cetera. So we have a plethora of new instruments, and that's in line with Tim Bergen's rule: for every objective you have, if you have an additional objective, you need an additional set of instruments. My fourth comment, which I disagree with Tam on, is on the criticism of internal risk models. I think some criticism is certainly well placed, and they had their shortcomings, without a doubt. But internal risk modeling has its benefits. It's very important for a bank that the bank culture and the way the bank actually drives its business and the incentives it provides to its account managers, that they actually feel they should be risk-oriented. And they have to know that if they give a credit to a new startup or to a high-risk business, they have to know that this is much more risky and will require much more capital than if they give it to a mortgage. In my country, mortgages, we know, there's decades of experience, households pay back their mortgages in the Netherlands. We don't know why, but they don't go to the movies, they cut back on restaurant visits, they don't go on holiday anymore as long as they pay their mortgage. That's strange, but that's the behavior of the families. Now you should take that into account when you drive your bank. Then you know this is a low risk exposure and you need less capital against the high risk exposures. Of course, you have to have a limit to the extent in which you do this internal risk modeling, so you need a backstop, and that's the leverage ratio in the new Basel Agreement. So you have a limit to the extent in which you allow banks to fiddle around with their risk weighting. My penultimate issue is on the issue of the lack of a public, a regional, a European public backstop for banks. I agree that when the banking union is totally finished, you need a European backstop. You need a European resolution fund, a European deposit guarantee fund, and a European public resources to save banks. But fundamentally, it's not that important, because the route we are trying to pursue now in Europe is not to have any more public money go to banks. If a bank goes broke, private financiers are the ones who are going to pay the bill. So we're introducing layers of risk-bearing capacity in the balance sheet of banks. We've introduced MREL requirements, minimum required eligible liability, and TLAC requirements, total loss absorbing capital in banks. And this is much thicker than the initial capital requirements of banks. So there's a very thick layer above this, at least double the initial layer, to carry the risks if they should come to bear. Beyond that, we are also introducing depositor preference, so that if there is a request to financing from a deposit guarantee fund, that deposit guarantee fund will have preferential treatment when there's a wind down of the assets of the bank. So the deposit guarantee scheme is going to probably get all its money back. Basically, what I'm trying to say is that the tail risk that is borne by the government, we're trying to make that very, very small. And we find that that is more important to reduce the risk of the public providing finance to banks than to go ahead and provide a public fund to support banks. That brings me to the final issue. Tam's book is called Unfinished Business, and this is a catchy, a good title, and I know Tam is good at titles. Let me just say there's a lot of finished business as well. We've done a tremendous amount over the last 10 years, and I think it's important to acknowledge that. The capital ratios in banks have really been improved, so that both the quality and the quantity of capital has been increased. The highest power, the best quality capital has been quadrupled since 2007. We have looked very critically at bank business models. In my country, all bank insurance companies, we've split them up. ING is now a split bank and an insurance company. Fortis was one of these conglomerates. We've separated them out. They're all, the bank balance sheets are much leaner, at least in my country. And I know that a lot of other European countries are lagging a bit, but they're going through the process as we speak in these times. We've created a single resolution board and a single resolution mechanism and resolution instruments and legislation that allows countries to implement bail-in on banks to avoid the government paying and having the private sector pay. We've created a systemic risk board, the ESRB, in Frankfurt to monitor the progress on the macroprudential front. We've had all European countries establish financial stability authorities. All European countries have established legislation creating macroprudential instruments. We've created a banking union, the SSM. We are in the process of creating a capital markets union. All I'm saying is, which I think is an important thing, we are moving forwards. And indeed, Europe is perhaps even more a political process than an economic process. And I saw it certainly when we saw the speech of Macron 2 days ago, that there is some momentum to move forwards to tackle those issues that Tam has identified need to be issues. But these, again, are very small qualms with what is surely an excellent book that I would highly recommend all of you to read. Thank you.
Thank you so much. So much to discuss. Do you agree, Tam, that the fiscal backstop is sufficient? Even if we now reduce the tail risk, Art talked about tail risks. Art also talked about Natia and uncertainty. The two don't go together. But do you agree that we've done so many steps?
I have quite a lot to say about Natia and uncertainty, certainly in the book. Yeah, look. After the crisis, there was an idea that we'd actually have much smaller banks, and that never happened. If you looked at the earlier graph, basically, the 12 mega banks were still. So obviously, if you're not going to make them smaller, you have to have some other mechanism. There has been this move towards bail-in. What I deliberately did in this book with my conclusions was not to get into all sorts of things which weren't part of my story to start off with. Okay. There are all sorts of issues out there that I could have burrowed into. But the point was, what I was trying to tell was how the crisis came about and what we've done about those problems. Okay. Now in that, take internal risk models. Sure, we've got a little more control, but not that much more control. I mean, in the end, it's very difficult to understand what a bank is actually doing with this internal risk model. That's why it's called an internal risk model. And the important thing is to understand about these models is they are highly, highly pro-cyclical. Okay? What happens is these models, if you're in a boom and asset prices are going up, it says everything's safer. Therefore, I can lend lots more money. That's not what happens with a simple leverage ratio, okay? Where the ratio stays the same regardless of the asset price. Obviously, the internal risk models are working reasonably well at this stage because Europe's in a recession and the internal risk models, they hold a lot of capital. It remains to be seen how well they will work if Europe starts going into another asset boom. So on that...
Can I ask you this? Because, I mean, Art enumerated an array of issues that we have, an array of actions that we have taken in the way to construct the banking union. Do you think the system is more resilient now? Or?
Oh, I think there's absolutely no doubt. Look, if you weren't more resilient than you were in 2008, you better start worrying. No, look, obviously the system is tremendous. But my point is that a significant amount of this has dealt with symptoms. I think that a little more thought needs to be made about causes. And the reason I focused on internal risk models is I identified them as a deep cause of the destabilization of the European banking system. And, places like the UK do have leverage ratios. So far, the ECB has not adopted one. So Anyway, so the point was, just on a couple of, look, enormous amounts been done. I think, having individual countries responsible for saving their own banking system still creates a funny dynamic between the ECB supervisors and the domestic banking regulators. And I think
There's a
that
fundamental
seems pretty-
issue there, Tam. We don't think individual countries are going to be saving their banking systems anymore. So we think it's the bail-in, it's the private financiers, at least
Yes.
in first instance. And I grant you, we did see it occur in the case of the Spanish rescue recently, not in the case yet to the degree one may have wanted in other cases, but we're moving in this direction.
Anyway, look, obviously reasonable people can disagree, but it does worry me, this separation of, look, if you've got one person saying how you should do things, another person paying for it, that's never a good system, okay? Just, on a sort of economics 101 basis, right? It's not. It's not the perfect system. Even if you claim, actually, neither of you will be involved and somebody else over there is going to pay, it's still not a good basis to have your government support system. So.
Okay, but perhaps this is the time to open up the discussion. Please. Okay, lots of questions. Can we have the gentleman at the back and then Marek? Can you introduce yourself again?
Hey.
It's on.
I think it's on. Thanks. I'm Błażej Błasikiewicz. I'm from EBF, but I'm here in personal capacity as you. The question is, first perhaps you said no one, how is it that no one has realized what was going on? I just referred to a speech that one investor gave in 2006 in front of 3,000 mortgage bankers in U.S., Peter Schiff. Great speech, and pretty much explains what you are explaining. I would like to go, because in nitty-gritty you are right, I think we cannot say, I'm not here to, as I say, discuss the banking. In a very much broader picture than your book, for me personally, the last crisis was a debt crisis. We had incredible amount of debt in the system. Now, the question is, I think at Q1 2017, IIF issued the debt report, and now the global debt is at, I think, staggering 217 trillion US dollars. Global debt to GDP is over 320%. Now, can this be a problem? Have you looked at this in your book? Are you concerned about this, sir? Thank you very much.
Shall we collect questions? Or would you?
Yeah, I'm happy to have several questions.
Yes, let's collect a few. Marek here at the front, and then there was a lady there. Yeah, just Marek first, here.
Marek Dąbrowski, Bruegel. Thank you for excellent presentation. Unfortunately, I didn't have opportunity to read your book. Regarding presentation, you concentrated on regulatory weaknesses of the banking sector. But in my opinion, in presentation, you largely miss, or you mention only en passant, macroeconomic policy, especially monetary policy. You mentioned about the great moderation hypothesis, but it was much more than that. For example, all this discussion in 2002, 2003 about imminent risk of deflation, which led to excessively loose monetary policy. Probably we would not have this kind of crisis without having a macroeconomic view. And in this context, what you think about current situation when we have even much looser monetary policies everywhere, and we have also now a lot of warning comments like Bob Schiller, Jeffrey Frankel, Nouriel Roubini about building new bubbles. So perhaps we come, even having stronger regulatory framework, perhaps we came back to the same situation as 2007. And another problem which you also mentioned, but also I would say marginally in the context of how large was ING, for example, or Deutsche Bank, it's a problem of too big to fail. It seems to me that now banking sector is even more concentrated on both sides of Atlantic. So whatever happens, I don't share your optimism about bailing in mechanism. It may work in smaller cases, but I'm afraid that if it something happens with really big banks, whether we like or not, public authorities will have to step in this case.
Okay.
And maybe third short remark is about analytical framework in models. I am afraid that not very much change, at least in one aspect, that we still deal largely with macroeconomic models which are limited to one national economy, simple national economy. We don't have really good models of global economy or global financial market, of global liquidity, etc. Thank you.
Thank you, Marek. There was a lady here at the back.
Yes, I was wondering about, like the previous question, what about the coming potential bubbles, like dot-com, and I'm working in healthcare in U.S. and there are very unstable health insurance market right now, so what can you prevent? Again, how can people know about this kind of risk anyway?
Shall we perhaps take
Yeah.
that from...
Could you repeat this last question where you answered?
Yes. So the last question was about the coming potential bubbles. I would say all three questions had to do with a couple of themes. So let me talk about them. One was, has QE created a bunch of new debt that will cause a new crisis? And of course, if we all knew the answer to that, then we'd all be millionaires. But what I would say about this is, understand that if it has or if it has not, it's not an unintentional consequence. Okay. What happened, right, was the private sector was completely unprepared to take risk. The governments came in and bought a bunch of assets to try and force the private sector to take more risk. So you may worry about the high debt, but don't think it wasn't part of the plan. Okay. So whether or not this happens or not, only time will tell. But the point is, you shouldn't, and of course, as was discussed, we've developed macroprudential measures to possibly take care of this high debt. So, but don't think that it's an unintended consequence. It's not an unintended, it's in fact precisely the intended consequence. In terms of the sort of the book being more about financial regulation than macro, yes it is. I was trained as a macroeconomist. If I wanted to write a book about the macro causes of the crisis, I would have. I do think that part of the story is blinkers in terms of the fact that the central banks were so confident that they could pick up the pieces that they only focused on inflation and didn't focus on financial stability. But I believe that the underlying causes of the crisis were bad regulation, which allowed banks on both sides of the Atlantic to expand enormously and to create demand through creating assets, through creating loans. And that it was the macroeconomic mistakes may have been helpers to that, but they were not the fundamental drivers. The fundamental drivers were allowing the banking systems on either side of the U.S. to increasingly expand with increasingly less capital behind them. Okay? So that's the story of the book. It doesn't mean that it was irrelevant whether who had what interest rate, okay? But it wasn't that important, okay? If Fed interest rates had been a couple of percent higher in 2007, 2008, I don't think it would have made that much difference, frankly. So anyway, that's the answer to that side of things. Yeah, and then I mean the macro models would come up, which I thought I already covered. Debt in system, yes, it is higher now, but as I say, that's because. So I think, but there was an awful lot of EC financing over the crisis as well. So I think that sort of answered where those questions were coming from, if not the precise question.
Okay, let me go back to this issue of debt, because I mean I know it's not part of the story here, but I mean here we are. We are in an environment where the stocks of debt, take the Netherlands for example, I mean household debt is 20% or something like that.
More
that order of magnitude. There are of course savings in them. The households also have a lot of savings, so that's why the Dutch households are not as vulnerable as the debt would imply. But how do you see the way going forward? And since resilience is the I think the underlying word in all that we're interested in. How can we move forward when the stocks of debt on households and on corporates and on banks are so big? I mean, do you take the view of Carmen Reinhardt, who said without some real, effectively debt forgiveness, because I can't find a better term for this, we are not going to actually be able to go back into a sort of a steady state that is healthy. And if we were to go down that route of, who would bear the cost? So while I know this is a stretchy question vis-a-vis the book, I think in the context of moving forward,
look, particularly in the emerging market context, there's been an awful lot of work on telling good rises in debt from bad rises in debt. Okay? So there's been enormous literature on sort of whether you can tell whether a crisis is going on or not. To which the final answer, as far as I can make out, is sometimes you get a crisis, sometimes it's all fine. And carries on.
Can you tell one from the other?
And it's extremely difficult to tell one from the other. Okay, that's the final conclusion of that literature. So it might be a bubble, it might not be a bubble. I'm not sure I can tell you much more than that from the point of view of being an economist. That's just my reading of the existing literature, which is why I don't sort of. Well, one other thing, by the way, which was brought up was. Having non-recourse mortgages so that these people have to repay their mortgages. Well, firstly, you do wonder, well, look, in the US that didn't happen. Although there were recourse states and non-recourse states, in essence, the entire US market was effectively counted as a non-recourse state, because let's say you're in a recourse state, right? All you have to do is move to a non-recourse state and the guys can never get the money back. So, in essence, now, I don't know. I'm not sure whether the banks understood these mortgages that they were selling people better than the individuals, but I'm pretty sure I know that most of them did. And therefore, forcing the individuals who took these questionable mortgages to repay and not go on vacations and not buy milk and all this kind of stuff, is the solution, I'm not sure. But that's my own personal view about recourse. So I remember talking to people in the UK who were saying how great it was they had such a low default rate on their mortgages, and I was like, well, that means they're not spending money on something else.
But you have the extent.
Maybe I can react to this. We have the experience, and what we see in the Netherlands is that the defaults that banks have to deal with are very small, but the cuts in domestic expenditure are very large. So the households claw back on their consumption. So the financial cycle is much deeper and more accentuated in the Netherlands than elsewhere. So the point Tam has made, the need to lower the debts, to shorten the balance sheets. We have these long balance sheets of bank mortgages and pension assets, and to shorten the balance sheets is clearly something that really that's part of our unfinished business, put it that way.
But I think part of the narrative in the Netherlands, and correct me if I'm wrong, is that the insolvency rules for households are extremely tough.
Very tough. Very pro-bank.
Exactly. So that's maybe a solution to reducing the balance sheets. You make this insolvency law less tough on the households, and then they're not in arrears on their health payments, and they get in arrears on the banks. I mean, it poses questions that go beyond just the banking system. It's about a welfare system. Because we see the numbers in the Netherlands on the welfare side on paying for the insurance, the national insurance, reduce.
Well, as a central banker, I'm quite happy that
Well,
people
yes,
pay back their
that's right.
mortgages. But yes.
Yeah, no, of course, I understand that, but I think the central bank still cares about welfare. So this is a question that is, of course, it's different context. But Art, I'd like to invite you if you have any comments on the questions or anything else.
No, I don't. I just had this one.
Okay.
Comment. Let's have Tam.
Sure. Any other questions, please?
Heiko Hesse from the Commission on leave from the IMF. I have one question. First of all, thanks for the excellent presentation and discussion. Isn't there a bit of a tension if you look, to follow up on your debt question, if you look at Japan, where you have essentially a very captive domestic investor base, banks, pension funds, and they probably have the highest debt to GDP ratio in the world. And on the other hand, if you want to break the sovereign bank nexus by, for example, putting risk rates on banks' own sovereign bond holdings or concentration limits, is there a potentially unintended consequence in the future, come the next crisis, who's going to buy your own debt if you don't have a captive domestic investor base?
Last was the question.
Well, I spoke up formally with the Commission. First of all, a comment. I'm a Dane, and we have a system, I think it's about 100 years old, with securitization of mortgages. And it works perfectly well because if you have, say, 100 people who have a house, they take out a loan with the security in the house, and you pay also a contribution in case somebody can't pay their mortgage. So the system works in the way of solidarity, that in case somebody can't pay, well, this fund goes in and bails that out, and you have limits in terms of how much you can take of a loan, 60%, 80% of the value of the house. So that's just a kind of situation, it works very well. I suppose what went wrong in the U.S. is that two things. First of all, they sliced and they packaged and they completely lost the contact with those people who actually took out the mortgage and those who were buying the mortgage and thinking this is fantastic product, it's giving me a high return. In the Danish system, there's a direct link between me taking out a loan and then having to be responsible for it. I think the second element in the U.S. system is that if you can't pay your mortgage, you just send the key to the bank and say, here, I'm going to go and thank you very much, and I'm trying to find my way in life. In the Danish system, you can't do that. You are personally, liable to the loan you're taking out, whether you can pay it or not. So you will have to have that burden. So there's a big difference between the securitization that went on in the U.S. and, for example, what we consider as a very safe system where there has never been a run on the credit institutions. That's one comment. Two questions. I think it's Neil Kaskari, who was one of the central bankers in the Fed system in the U.S., who has been arguing that even today he thinks that there are banks clearly too big to fail, and therefore there has to be a breaking up of the big banks, and I think that certainly would also be relevant in the European context. Privately, I have my account with ING, and I wouldn't like to see that happening, that suddenly it fell over and I would lose whatever I have of assets. I don't have any assets, I only have loans and debts, so that's fine. But
That's right.
could you comment on this too big to fail, if that's still not a serious risk in the market? And the second question is about I think it's Barney Franks, who back in 2010 in the U.S., they took some very serious steps in order to try to separate the investment banking from the commercial banking and to avoid this kind of interlinkage. Today there's a discussion, certainly amongst the Republicans in the first instance, trying to liberalize again and go back on that. How do you see that? Thank you.
Thank you, Lars. Any other question? Yes.
David Lombardo from DG FISMA and the Commission. I wonder what's TAM's view on the proposals in some literature of moving the regulatory philosophy from capital against risk-weighted assets to, in fact, equity. Because I think that seems to me a way to reconcile the importance of banks being mindful of the risk that they take, but also the fact that they need to do so in a kind of a good faith manner without taking shortcuts, which in the end are translated, whether we have the bail-in or not, onto the public sector.
Okay.
Please.
Okay. I think the Dutch system sounds great. They may call it securitization. I wouldn't call it securitization in the way that happened in the US. Part of my book is also, I try and explain why I thought the generous ratings of the debt in the US did not come out of some conspiracy between the investment banks and the rating agencies. It was a natural result of the fact that all of a sudden, rather than GM producing a bond and then you rating it, the bond was actually being designed with the rating in mind. Okay, so the ratings deteriorated because the system had been inverted from here's a bond, here's the rating, to here's the rating, let me design the bond, if you see what I mean. And I think that fundamentally produced a different system. Volcker rule, look, yeah, I mean, I discussed as I say, from the point of view of my story, the Volcker rule, I think, is, it's a reasonably controversial thing. We'll have to see where everybody comes out on it. From the point of view of my story, the really important thing is that the investment banks are under real banking regulation. And that actually comes partly to the question about the U.S. banking regulation. What's interesting about U.S. banking regulations, at least for the largest banks, they are under 3 sets of capital regulations. The first is their own internal risk models, but the second, they are under the same standardized risk weights as all the smaller banks. Okay, understand, internal risk models are only for big banks. The small banks had to just put their things into various buckets and say this is 50%, this is 30%, etc. Okay? So this gave the big banks, and still gives the big banks in the euro area, a competitive advantage over their smaller competitors. Because they can, in the US that doesn't happen, because you've got to have a minimum floor on the risk weights, which is actually the buckets which Basel imposes. Okay. The third thing in the US, though, is that at least the large banks are under a simple leverage ratio between 5 and 6%. It depends on the exact part of the, right. So in my view, sort of the risk weights and the simple leverage ratio play about the same role, which is good. That's about where you should be, right? So that you can't manipulate either of them. Because there are disadvantages, by the way, with a simple leverage ratio. It gives you all sorts of incentives to make more risky loans. Okay, because you have to put the same amount of capital against everything. Why not go for the big risky things? So I don't think the simple leverage ratio is the answer to everything. I think this US system, where in a sense the two kind of are likely to both matter, actually makes perfect sense. And that's actually one of my concerns, even with the Basel leverage ratio, which is intentionally used as a backstop. And I think it shouldn't be a backstop. I think it should be something more central. In terms of Kashkari, yeah, one of them, he's got that element of breaking up banks. He's also got an element of having much more capital for banks. One of the discussions which I deliberately didn't get into in this book, because I didn't think it came out of the story of the book, is whether you should have double the amount of capital everybody's currently demanding or not. And that's really interesting. Essentially, it pits the economists against the regulators. Because the economists, by and large, still think that you have too low capital. All I will say about this is, in the discussions of Basel II, there was exactly the same discussion, which the bankers won, and it turned out that was not a good outcome. in the end, because Annex extended internal risk models, not just to investment banking, which I talked about in my presentation, but to the entire banking, to the entire bank, okay, including the commercial loans. And as I say, a lot of the economists said that they weren't that happy with that. Japan, well, Japan, I think, is actually, an example of why you actually do need to deal with your banking problems. As an example, if I was going to take Japan as an example of anything, it would be that if you don't really deal with the basics of your banking problems, then you can end up in a very long period of low growth, which, to be fair, I think is, to a first approximation, also where the euro area has been for some time.
Okay, thank you very much, Tam. Are there any other urgent questions of Art? Any final
Well,
thoughts?
I just wanted to react on the point of Japan. I find the logic of saying, well, let's not introduce concentration limits or let's not introduce risk weights for governments because we are so exposed and we need a buyer of this debt is a very vulnerable one. Because basically you're in a place where you don't want to be and you're not allowing yourself to move out of that place. And I think you can devise a lot of schemes, doing things very gradually, very slowly, but trying to get the dynamics back into the place where you want them to be. So I don't know, that would be, but I know that's outside the scope of Tam's book, although he touches upon these issues as well. But
Great. Well, thank you very much. I started by saying what a good title it was. I quite liked that spin, actually, on the title, that we have a lot of things that we have done, and I think we need to acknowledge that there is a lot of effort and thought put into this, and I think that's a good thing. I mean, otherwise it would have been a bit troublesome, as you say, Tam. But I mean, I also buy the point that there's a lot, in particular with the architecture of the euro, there is still a lot to do. And so, I tend to agree there is an unfinished business. I hope we find it in us to complete.
we need people like Tam to keep us ambitious,
exactly,
and to keep us sharp.
Absolutely. Well, with that, let me then please join me in thanking both Tam for coming and Art for joining us for this discussion. Thank you. Thank you so much. That was